Good morning. It's Tuesday, the 5th of November, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. Well, the United States elections are today, and both former President Donald Trump and Vice President Kamala Harris are neck and neck in the polls. Who will win? We don't know at this point, though the markets are pricing in a Donald Trump victory. But we will probably know for sure tomorrow morning, unless the outcome is disputed in the courts. But the larger issue is that India has many economic issues and matters to grapple with in coming months and the energy to focus on them, which brings us to the take. Stock markets in Asia rose on Monday in anticipation of the United States presidential elections that will take place today. They included Korea, Hong Kong, Australia, and Taiwan. The United States, already sitting on record highs, were also ticking up on Monday ahead of elections. That's Wall Street. The Indian stock markets, on the other hand, were down sharply in keeping with the sell-off trend that started in October and have extended into November, apparently. Whatever the reason may be, the jitteriness in the run-up to and the speculation on the outcome of the US elections clearly has little to do with the Indian market's recent movements, even if that is being offered as a reason. Indian markets are now diverging from both Asia and the United States and to some extent Europe. Now, this is worrying and reflects a disconnect that could be larger than just the movement of indices. For one, a slowdown is clearly upon us. According to a Bloomberg report, last week, Jefferies Financial Group, the stockbroking house, said over 60% of the 98 firms they track have had their earnings per share estimates downgraded following the recent quarterly results. This is the highest proportion since early 2020 when the COVID-19 pandemic upended economic activity for months. Jefferies is now forecasting that the earnings of Nifty companies will grow at just 10% in the year ended March 2025. Analysts often remind us that the stock markets are a slave to earnings. Indeed, if that were the case, then the slaves, so to speak, have tougher times ahead. Moreover, India's economy is now quite literally moving in the opposite direction to the United States, which is powering ahead with a pace of economic growth not seen in a long time. The reasons for slower growth in India range from a fizzling out of the post-pandemic surge to a curtailing of consumption thanks to the triple whammy of heat waves, heavy monsoons, and of course elections. Now, all of this could partly be the reason, but it cannot be the only reason, and it should also be pointed out to those saying so that hope cannot be a strategy. Despite the government amping up expenditure in public spending visible in areas like roads and railways, the private sector has not picked up the slack. Now, this is not just in the last few months, but several years. Data shows over this time that both private spending on capital expenditure and private consumption are weak and staying so. Companies, of course, continue to do well, or at least till now, because they're going all out to preserve their margins and profitability, including by downsizing, as the information technology services company did in the last year. So the question that I've posed before as well is, did we see it coming? And if so, what could we have done differently? Did the companies who are now speaking of taking a hit because of urban consumption slowing down not see this happening or the likelihood of it 6 to 9 months ago? Did they not get a feeling that the consumption spike was more of a post-COVID phenomenon? Remember, many developed markets were already accounting for this post-COVID spending dip. And then the question really is, could we be different, and how much, if so? And the financing of all of this, the Reserve Bank for more than a year has been sounding the alarms on rising risks in micro, personal and credit card loans and borrowings. Early signs of defaults were already there, and the fact that higher than normal borrowing was funding this consumption of products, services, and then speculation in the stock markets was also quite evident. There is a signal and noise problem in the Indian economy. The amplification of various data points at very high levels creates a distortion effect. This is not to blame those putting out the numbers, but to caution those who look at them and worse, wrongly interpret them. The question one can now pose is whether what we're seeing is cyclical or more of a secular slowdown. It is tough to answer this without more data, including on what really happened in the last 4 years, so we can focus on what to correct for. Meanwhile, while we eagerly await the outcome of the US elections, we have to focus more on what and how to correct in our own Indian economy. And that brings us to the top stories and themes for the day. Markets fall the most in a month as investors turn nervous. Production cutbacks by OPEC push oil prices up. Meet the world's largest oil producer, the United States of America. And the United States is heading for America first, whoever comes to power, and what that means for India's exporters. And finally, Thailand extends visa-free travel for Indians.
This is a Core Report with Govindraj Ethiraj.
The markets and their worst days. Indian markets have had their worst day in more than a month on Monday thanks to rising jitteriness attributed to the US presidential elections. Both the Sensex and the Nifty were down over 1%. The Sensex fell 942 points to close at 78,782, while the NSE Nifty 50 ended lower by 309 points to close at 23,995. The Business Standard reported that 42 of 50 constituent stocks of the Nifty 50 were in the red, pulled down by stocks like Hero MotoCorp, Grasim, Bajaj Auto, Adani Ports, and BPCL, with all falling more than 4%. On the other hand, stocks like Mahindra & Mahindra, Tech Mahindra, Cipla, State Bank, and Dr. Reddy's were up, ending in the green, going up more than 2%. The Fear Index, which is the India VIX, which measures volatility in the markets, was up by more than 5% to 16.7 points. The broader indices like the Nifty Mid-Cap 100 and the Small-Cap 100 fell more than the benchmarks. So the key indices have now fallen around 6% each in October on record monthly foreign outflows and dull earnings. Remember, yesterday we spoke of how foreign portfolio investment outflow has crossed $11 billion in October. But you also have to remember that the markets had gained 15% in the previous 4 months and were obviously sitting on record highs session after session. However, all of this means that they're still overvalued compared to historical averages, analysts told Reuters. All eyes are, of course, on the US elections, but what are the other signals to look for across Asia and India, particularly as viewed from an outside India perspective? I put this question and theme to Peter McGuire of Sydney-based XM.com, and I began by asking him what other cues he was watching or tracking apart from the US elections.
There are so many different moving parts to this that really need to be deciphered and really, pulled apart. And if we start with a quick snapshot as far as US, I was very disappointed Friday at 12,000 jobs on the NFP. We were expecting 100,000 or more, maybe even there was talk of 130,000. And you had an average, the forecast was greater than 100,000. Now, the private sector lost 28,000 jobs, government employed 40,000, and we had the NFP run at 12,000 jobs, now, which is very, very soft. So we also revised down, and this is what's got to be thought of, August and September were revised down by a combined 112,000 jobs over that, and the retail sector only lost 6,400. But 8 of the last 11 jobs reports have now been revised lower, and you've taken 1 million jobs out of the market in the last 2 years. So that worries me from a US perspective. Now there are red-hot equity markets. If I look at across Asia, Japan's down 2.7% today for the Nikkei. Some of these markets have performed incredibly strong over the last 12 months. It's been extraordinary. India is, up 32% for some of their indexes, the BSE 200, the BSE 500, both in excess of 32%. So you can't say it's just a raging bull market, and they do have wipe-offs. You strip out 5%, but hey, you're still up 32% for the year if you've been a long-term holder, Govind.
Speaking about India and Asia in specific, how is the region looking to you at this point?
Well, I think Asia's looking, it depends on whereabouts in Asia. And if I look at China, massive overhang as far as property. They're trying to stimulate the economy. They've got major concerns as far as exporting their way out. They've got deflation. They've got huge debt. They've got a debt to GDP at around about 3.66%. So every unit of GDP manufactured or created, it carries 3.6% of debt. So that's not a good sign at all. I think 25 is going to be a very tough year for China. If I look at Japan, well, the market's been extraordinary. If I'm looking at the Japanese market, that Nikkei 225 is up 20% for the year. Some of their markets are, up the best part of that. And that's a strong market considering for a market like the Japanese, that's quite extraordinary, I think, any market to carry 20% for a year. So there's the story there, nearly at all-time highs for the Nikkei, only about 4,000 off, or 3,000 off. So, yeah, it's relatively okay.
And to pick up on the China point, we've seen a lot of capital flow into China, including from India, and we've seen a lot of foreign institutional investor selling in the month of October, almost $11 billion. Do you see any changes or shifts in that, or reverses in that trend? And if so, what could drive that?
Well, you've got to ask the question, will stimulus solve China's debt crisis? And that's the issue that you've got to face, that how are they going to deal their way out of this? And if there was to be some form of, a change in policy, should President Trump be re-elected, then Govind, he's talking about tariffs and going to really load those up and load them up dramatically against the likes of China and bring manufacturing home. He's got a drill, baby, drill. That's his favourite word as far as energy. And there's talk of massive income tax transformations. So this is going to be extraordinary and to really shrink government. So, yeah, I look at that part and it's going to be fascinating how it plays out into the likes of China. So it's very difficult to imagine what the impact would be further to China. And since 2008, their GFC, the ratio has doubled to their debt to GDP level. So it's China is certainly in a debt bubble.
As you look at other asset classes, Peter, for example, gold, where we've seen prices go up almost 32% in this year, and silver has gone up as well. How is the asset class environment looking to you, particularly, again, as you see it across Asia?
Well, I've got to look, first off, gold is just extraordinary. It was at $1,810 or so was the low of October last year. We've just gone into November this year, so 13-month window, you're up nearly $950 on 1,800. So I don't think anyone really, hand on heart, could have imagined that. But then you've got to look at the other side. Of all the dollars ever printed by the Fed, you've got 40% were printed in a year. That was last year. So over the last year. So you've got massive uplift as far as precious metals. You've got an attraction from central banks globally and, of course, retail traders and the likes of India. So I truly think that there's more upside for gold and silver in the short to medium term. And I wouldn't be surprised for 3,000 to be taken out by, New Year's Eve. You're less than 2 months away, but the velocity has been unheralded. It's mind-blowing, Govind.
Looking at India, how are you seeing equities, particularly in the context of the fall that we've seen in the last month?
Well, look, any market that rises as aggressively as what you've seen, some of these up, 31, as I said, 32%, 35% if you add the loss over the last month. It's not unusual to see washouts, of 5 and 10% and quickly and aggressively. And that's probably what we're seeing at the moment. Now, is it oversold at the moment? I mean, the long-term projections as far as how I gauge India, it's the country to be. Everything just aligns from population, location, infrastructure spend. I think an aggressive political stance on growth and entrepreneurship and innovation. So I truly think that I keep on saying it's India's decade, but it's probably more like India's century. I won't be around till at the end of the century, Govind, and unfortunately I don't think you and I, we won't both make it. But I'm fascinated to see how the transformation looks to India over the next 20 to 30 years. I think it'll be breathtaking. So I don't worry about these little hiccups. I think the long term is just quite extraordinary, and it's probably a time to buy on the dips, and probably a little bit cheaper today than what it was a month ago.
Peter, thank you so much for joining me.
You're welcome, Govind.
Production cuts in the offing. The Organization of Petroleum Exporting Countries Plus will push back its December production increase by a month, the second delay in its plans to revive supply thanks to weaker demand, according to Bloomberg. The OPEC, which is led by Saudi Arabia and Russia, had intended to start a series of monthly production increases by adding around 180,000 barrels a day from December, but will now keep supply restrained throughout that month, according to a statement released by OPEC on Sunday. So the oil market is now grappling with slowing demand from China and increasing supply from the United States, and more on that shortly. Brent crude prices have fallen 17% in the last 4 months to trade near $73 a barrel. Too low, says Bloomberg, for the Saudis and many others in OPEC to cover government spending. Also adding that current prices are a financial threat for Saudi Arabia, which needs price levels close to $100 a barrel to cover the country's ambitious economic plans, according to the International Monetary Fund. Russia also needs higher oil prices to fund its war against Ukraine. So the 23-nation alliance of OPEC is set to meet next on December 1st to review policy for 2025. And now meet the world's largest oil producer. Whoever wins the 2024 US election should work to preserve America's energy dominance rather than losing it, Total Energy CEO Patrick Pouyanné told the news channel CNBC on Monday in Abu Dhabi. If you were wondering why he said it, here's the reason. The United States is now the world's largest oil producer, accounting for 22% of the global total, according to the Energy Information Administration, with Saudi Arabia next producing 11%. So you can see the gap now between the United States and Saudi Arabia. And I won't blame you for thinking that it was the other way around. The vast majority of US crude is, of course, consumed within America, which is also the world's largest oil consumer. So if you thought a Republican victory will lead to increased energy production in the United States, well, it's already happening. So when you look to what's happened, let's say in the last 2 to 3 years, production of oil has never been so high. The revolution of US shale is really taking place, Pouyanné told CNBC. Roughly 64% of US crude oil production is in the form of shale, and the French international energy firm's CEO, that is Total CEO, said the United States will soon be number one in liquefied natural gas, that's LNG production as well. Former US President Donald Trump and the Republican Party have long been pushing for more US shale production and a deregulation of the industry and an expansion of drilling projects, which of course has created much controversy amongst climate activists. What happens if the United States increases tariffs on India? Former President Donald Trump has warned of increased tariffs if he comes to power. Reports have said that there could be 10% broad-based tariffs and up to 60% on products being imported from China. Any tariffs on imports into the United States could fundamentally alter the terms of global trade as we know it. So what does this mean for India and who could be affected? Because this is a matter that calls for some detailing. Moreover, it is quite evident that the United States will become more protectionist regardless of who comes to power, particularly in manufacturing, as we will discuss shortly. Interestingly, the United States is now India's biggest trading partner, passing China in the last 6 months. So what does this mean for the roughly $109 billion trade figure right now, and how achievable is the $500 billion target by 2030? This is between India and the United States. I reached out to Dr. Ajay Sahai, president of the Federation of Indian Export Organizations based in New Delhi, and I began by asking him to first give us a short background on overall trade with the United States of America before coming to where we stood from the India point of view.
In fact, we have seen very robust growth in India's bilateral trade with the US. Not only our exports have zoomed, but even imports have seen an increasing trend. In fact, in 2023, our bilateral trade was close to $190 billion, out of which roughly export were $120 billion, import from US were around $70 billion. In the first 6 months of this calendar year, we have seen US emerging as the largest trading partner of India, bypassing China. And our export growth, despite the declining trend in overall export, has shown around 9% growth in export to US. Imports have also increased, but imports are on slightly lower side. They have grown by around 3%. Both countries are looking towards a target of $500 billion of trade by 2030. Looking into the trend and looking into the opportunity and the potential which we have, we are sure that we will be meeting that target by 2030. One good thing is that the trade with the US has been the little value-added product exports to US. We are exporting a lot of pharmaceuticals in textile sector. The focus has been on apparel. We are exporting machinery also to the US. And with India emerging as the base for Apple manufacturing, we are seeing much exports of mobile phone also happening. On the US side also, we are seeing a lot of value-added exports from US to India, dominated by machinery segment. US is also one of the emerging partner on the energy sector. And in fact, today, the crude and processed petroleum products, they contribute to around 33% of the total US exports. So we are seeing good partnership. We have quite with the US both on the east side and west side. And we firstly feel that a strategic relationship is probably going to drive the economic growth and trade partnership as well.
Okay, before I come to a potential tariff impact, you said that we've now overtaken China as the biggest trading partner with the US. So can you split that between imports and exports?
In fact, if you are looking into the first 6 months, in the first 6 months, our exports to US is close to $70 billion. and our imports from the US is around 38 to 39 billion dollar. So in all, it makes $109 billion. With China, it is much less, though, of course, with China, we are running a huge trade deficit as well.
Right. If there were to be a tariff put on imports from India, which potential Trump administration is talking about, and that number could be 10%, at least just going by reports. How are you seeing that?
In fact, we are of the view that whether Mr. Trump or Ms. Harris comes into the power, there will be increasing focus on America first, and they will definitely putting much more emphasis on manufacturing within US. So that is definitely a challenge to rest of the trading partners, including India. So far as tariffs are concerned, we feel that while Mrs. Harris may be a little soft on tariffs front, but Mr. Trump has already made it clear, and he has used it also in his previous regime also. Probably he may have a different tariff on all of the trading partner and a specific tariff, which may be probably higher tariff on China. I don't foresee that he will be putting tariffs across the board, but there will certain sectors on which he will be using as tariff to promote manufacturing, and therefore probably what he is not going to protect in the manufacturing may not be subject to that kind of higher tariff, but wherever he is looking into establishing the manufacturing into the country, higher tariff may come. Secondly, probably to encourage the US companies to bring the production from outside, he may also offer some of them tax concession. But despite that happening, I think the continued focus will be on China plus one, and that will provide much opportunities to country like India. We have seen that with the increasing tariff war and China plus one policy, we have seen increase in India's trade as well as investment, not only flowing from the US, but from many partners who were either looking into the expansion or new facility in China. So probably that trend will continue irrespective of who comes into the power.
So, if there were to be a tariff increase, and as you said, it might happen in areas that are more connected to US local manufacturing base or the potential of expanding it, how are you seeing the impact of that on Indian exporters and their competitiveness?
In some of the segment, there may be challenge for even Indian manufacturing, assuming he decide to provide much more protection to automobile sector, which is likely because that's a huge job creator. There may be challenges, but at the same time, it may open more opportunity for auto component manufacturing from India because we are emerging as one of the leaders for that. So probably loss in some of the segment may result in gain in some of the segment. So we have yet to see what are the sectors which will be covered, and in those sectors, how are that going to span in next few years. Because if he increases huge duty on China, it will be advantageous to other trading partners, including India. So probably matching will be made only when we know what are the product metrics of that. And that may help us in many segments as well.
Again, going by the past and your experience, what are the prospects of negotiating this situation out? I mean, if we are importing and we were to also, let's say, levy correspondingly high tariffs or higher tariffs, then clearly it becomes a face off.
We have seen that in the past also, because if any country is increasing the tariff, the other country will be taking some kind of reciprocal action. That may not be directly the tariff, it may be some other initiative also. With Mr. Trump coming in too, we have to be little careful on the trade deficit front, because he was a little apprehensive when he was running a trade deficit of only around $25 billion with India. Now the deficit has increased to more than $50 billion. That will concern for us. Probably he will pushing more for market access for US products in India, particularly the dairy product, the medical diagnostic equipment, and maybe the digital product. So these are the area of concern which may.
And Harley Davidson.
Absolutely. Harley Davidson, we have already reduced the tariff substantially. So I don't think that may be an issue. But point is that I think both the president, whosoever becomes the president, they will be keeping focus on the US interest. And if the past is any indication, the past indication is that we will see much more volatility in geopolitics if Mr. Trump comes to power. How it is span out in the trade terms is one has to wait and see.
Dr. Sahai, thank you so much. And I will surely come back to you once we know the results and how trade policy is likely to evolve. Thank you so much.
Thank you.
Thailand, here we come. The country of Thailand has indefinitely extended its visa-free entry policy for Indian nationals. That policy was supposed to end next week but has been extended. It now allows Indian visitors to stay in Thailand for up to 60 days without needing a visa, with an option to extend their stay by an additional 30 days at a local immigration office. The Tourism Authority of Thailand has announced that extension, with Business Standard newspaper confirming from the Royal Thai Embassy in New Delhi that officials have received instructions to continue the visa-free policy. They told Business Standard that visa-free extension instructions have been given to them, and they've also not been told when that facility will end for Indians. The policy was introduced in November 2023 and has evidently worked well, as it has for other countries, given Indians consider getting a visa a major hassle in a travel program. Malaysia too introduced a visa waiver for Indian tourists in December 2023. Now, Thailand has received about 9.5 million foreign tourists in the first quarter of this year and is targeting about 40 million tourists in all for the whole year, which is close to its pre-pandemic high in 2019. Some 1.6 million Indian tourists went to Thailand till October and are likely to touch about 2 million by the end of the year, according to that report in Business Standard. This makes India the third largest source of international visitors after Malaysia and China. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.